Hi there, Simon Atkins here. I'm going to be talking to you about interest rates today because interest rates are changing, aren't they? We're starting to go up, and is that the doom and gloom for property? Well, in my seven-figure knowledge class that I do for my clients, I talk about not so much microeconomic indicators. I talk about overarching principles that have really stood me in good stead over almost 30 years of investing in property in Perth. And the main reason for that is because a lot of people get very caught up in these microeconomic indicators, and quite often they really don't mean as much as you might think they're going to. Okay, yes, interest rates in a place like Sydney, where people have got a lot of debt over housing, I would imagine because of the median house price over there is around 1.2 million. That's going to have more an effect on other places. But generally speaking, these don't have as big an effect as you might think. Things like jobs, etc. People try and look into their crystal ball, try and understand what happens. And to be honest, most people can't figure it out. So I'll talk to you in a little bit about what you really need to know, which will give you the guide as to when you should buy and if you should feel comfortable about buying or not. The other thing that I want to show you was right here on the screen. It's the REWA Perth house prices 1974 to 2019. And the reason I like this is because it tends to remind us that regardless of what happens economically, regardless of what happens during over a course of decades, property still manages to go up. And the main reason for that is twofold. The banks are prepared to lend against it, okay, up to 95%. They believe in it, they know it's going to go up over time, therefore they provide finance for it, okay? They're the ones risking their money against the security of a property. Now, if they didn't like it, most people wouldn't be able to buy a property because, 99.9% out of 100 people need to be able to borrow money to be able to get into the property market. If you cut credit off, finance off, then the market would drop because people can't, save $400,000 or $500,000 or $1 million or whatever it is to buy a house. So, first thing is the banks like it and they create a product for it for us to be able to buy homes. That allows us to get into the property. Second thing is it's a basic human need. Shelter is one of the 6 basic human needs. So people are always going to be looking for shelter, whether that's you buying an investment property for someone else to live in or living in something yourself. Okay, so if we turn our attention to the graph and we look at what's kind of happened over, I'll just get rid of that, what's happened over a large number of years. We've got down here 1974 to 1978, prices rose by 112%. So between here and here, had huge growth, even though that's obviously small graphs, it's all relevant. That's 100,000 there. So it's all relevant to the prices at the time. Interest rates were 9%. 1978 inflation, believe it or not, I'm sure they've got that right, 20%, hard to believe. Over here in 1985 we had interest rates at 13%. Interest rates here at the peak in 1989, 17%, that's as high as I think they've been. And we had the Perth median house price rise just before that, 1988, by 60%. So even with these huge interest rates, we had massive jump there and consistent growth here. Now this is higher growth than you think because, like I said, it's just relevant to the fact that it's a low number. But then, so this was our boom period through here, and then came off and had a bit of a rest, but not for very long, and started growing again. Then we had a bit of a housing building boom. Obviously there was high supply then. We got interest rates at 7% back over here. And we're in a new interest rate cycle. So they went up, obviously, came right down very quickly, and started building up again. So we had GST 2001 to 2005. We had interest rates, we had the Gulf War, interest rates around 6.5%, and so on and so forth. Okay, so we got all this stuff until interest rates dived over here. Now, even so, interest rates are still long. The Perth house market still went down in these years. The last 2 years, you can't see it because my mug's in the way there. If I just move that, only goes to 2019. But if we had 2020 and 21 on here, and even what we've got ahead of 22, you'd see that the market started growing again here. Okay, so it started going back up again. But the interest rates, as you can see, have had very little impact. Okay, over a period of time that the prices have gone through their cycles, they've come up, they've boomed, then they've taken a bit of a rest, and then they've started to grow again, boomed again, and then taken a bit of rest back through to this period here. They had a bit of a mini boom here, which was more the mining stuff going on, which created that, and then it fell away a bit. But that's really, I think, if you look at these kind of graphs, it just reminds you that things like interest rates don't have as much effect as you might think, particularly if your house price at that particular time isn't, if you're not getting too carried away. The thing that really drives this and makes the property prices fall away is where you are in the cycle. That's what matters, where you are in the property cycle, okay? So if we can see here, and I'll talk about the property cycle in a second, but if we can see here how the property market still goes through its paces regardless of what's going on, regardless of interest rates or anything else, then we can feel that we can be pretty confident investing or buying a property. Now, it's fair to say, if you wanted interest rates to stay at 2% or whatever it might be, they're never going to stay there anyway, and you're going to hold a home or an investment property for 20, 25 years or whatever it might be. Investing is something that you've got to be doing over a long period of time. So whenever you buy that property, whatever indicators are happening at that time, whatever they're showing you, it's going to be different at various stages of you holding that property. So you have to be able to hold it through time. And the reason we like property, and the reason why the banks like it and they like being able to lend money against it, is because they can see regardless, property goes up over a period of time. It's not that it doesn't have its times where it goes a bit flat or it goes a bit backwards, because it certainly does. But generally speaking, that trend from here to here is very much an upward trajectory. So I just got that out. So as you can see, that's why you shouldn't be too worried about interest rates. The other thing is, we've been in a very, very, very low interest rate environment, historically low, never been like that before, and you tend to get used to that. And then the media just likes getting on board and making it sound out like, it's madness with interest rates going up. It's just normal cyclic stuff. And we're going to go back to a more normalized interest rate situation. So if we were then to look at here, so the property cycle, I mentioned that. And if we're looking at this property cycle, then we can see if the 12 o'clock here, if we look at it like a clock, and this is 12 o'clock, this is the peak of the market right at the very top. And then once it's hit the peak, it falls away, it takes a break, and we start to, prices might drop a bit and stagnate, okay, for maybe a handful of years or a few years. We've had a very long stagnation period here in Perth, really for about probably 12 years or so. And all these kind of things tend to happen. Not necessarily everything, but certain amounts of these things. And then we get down to 6 o'clock here, where we're at the bottom of the market, okay? So this is where essentially it's hard to talk people into buying a property, but this is the best time, because that's when the prices are the best and the outlook is the most positive, okay? The opposite of that is starting to come in as we recover. So Perth's in this area now, recovery, okay? Last couple of years we've started to grow again. We're seeing rental increases, aren't we? Very low vacancy rates, high rent returns, and we're seeing housing levels tightening. We're down to very low stock availability at the moment, and houses are being bought off the market at a quicker rate than they have been for many years in Perth, okay? And that creates rising prices. So we're in this area here. What we don't want to be doing is, if we just continue the cycle on, just so you can see the rest of it, once we get up right towards the top here, we don't want to be buying in these areas. That's really the time you don't want to be buying, because what generally happens is the market overshoots itself, people get too excited, and it becomes almost like a bit of a Ponzi scheme at the top here. Someone's buying a house because they just believe that it's going to go up in value because it's been doing it for quite some time, and they think it's going to keep going. The way to look at it as booms, people think when it's in a boom that it's never going to end, but the way to look at it is it will end. And when it's at the bottom here, people think the market's never going to recover, but it will. So both of these ideas, that the boom will never end and the market will never recover, are both wrong. The boom will end and the market will recover, and it will keep going around in the cyclic fashion. So just to kind of round this out a little bit, I've also got, I kind of showed you, I've shown you on this graph here that you needn't worry about the growth scenario for it, and that's really why you're investing in property, is the growth. Okay, economic factors are going to change, they're going to differ as time goes on, but you hold on to your property over a period of time and just let this compounding growth do the work for you. Okay, this will get you to where you want to go in terms of retirement or whatever else you want. The next thing I want to show you here is this little scribble that I've done. Excuse this, but I'm just trying to prove you a point here. Again, and this is around cash flows. So if interest rates don't affect the growth of the property so much, what about the cash flows on the property? So here in this example above the yellow line here, I've got my normal drawing that I do with an investment property, and these are the numbers going into your bank account from this investment property over the course of a year. So into your bank account, don't take any notice of that, 7,500 at the moment. So these two numbers go into your bank account over the course of a year, and these numbers come out of your account over the course of a year. Okay. So of course the first thing we have going in is rent. Okay, that comes in from your tenant, and for this property, I've worked it out at about roughly, I've done the modelling numbers on it. It's around about a $450,000 house, getting $470 a week rent, which is probably a little conservative at the moment given how rents are, but that's fine. Okay, so we'd be getting about 14 grand a year rent going into our account. On the reverse here, what would be going out would be the interest on our loan. Now I've worked this out on an interest only loan at 3%. So the loan, and it's fully borrowed. Okay, so you haven't put any money into this. It's assuming you've got equity in your property and you borrowed the full amount to buy this little investment property. So it's all borrowed money, and the interest on that would be per year $14,166. Now it's interest only because that makes it's all deductible. So you don't have to do a principal and interest loan. You can do interest only, and that makes it strengthens your cash flows, and it means you've just got deductible amounts going out. On the other part of the equation here, the other thing that goes out are your expenses. So your expenses are your rates, your taxes. Obviously not your utilities because the tenant would be paying for those, but your other general property expenses plus property management fees. Okay, so that's what that's bundled up with there. And the next part is the tax refund that you'll be getting. So I worked this out on a person that bought this property on $100,000 gross a year, and they'd be getting something around 4.5 grand back in tax. So these two amounts would be coming back in their bank account. These two amounts would be going out, and at the end of the 12-month period, you'd be left with $7,500 in the account. So that's really sexy. It's never looked that good, and the main reason for that is because we've got strong rents at the moment, and we've got very, very low interest rates, which makes this number very low. Never seen this before, and it may never come back again in our lifetime, and it may never come back at all. I'm sure maybe it will at some point. Who knows? But the fact of the matter is, it's the strongest position as you're ever going to get in terms of your average investment property that you're leasing out, your residential investment. Below the line here, I've left these numbers out because I knew you'd probably want to take a peek while I was talking about this. I just wanted you to focus on this. So if the interest rate's 3% up here, what I'm trying to prove here is 5%. Now, if the interest rates go up 5%, how is this going to affect our cash flows? We've seen that the interest rates don't really affect the growth, but how do they affect the cash flows? Well, I've pre-worked this out, and I'll put the numbers in for you now. Well, actually, the rent's not going to change, so I won't put anything in there because I don't want to put you through the pain of watching me having to type it in. But that's still the same. Obviously, it's not going to affect the rent. I mean, it might affect the rent somehow, but it's not directly going to affect the rent. So 14,166 you'll still be getting in here. The interest rate's obviously going to change because now we're paying 5%. So if it goes up to 5%, I've worked that out at 23,609. So instead of 14,166, we're going to be paying 23,609. Okay, so that's quite a jump, obviously. 2% rise. And so that means more. And this is where people start to think, I don't want to buy an investment property. I'm going to get flogged with interest rates and all the rest of it. Okay. Now, the number down here is going to stay the same as what it is up here. Your expenses, your other expenses are going to be the same relatively. It's not going to change your rates and those types of things, or your property management fees. So you can take that 6696 and put it down here. That would still be the case. The only other thing that would change is you'd get some more tax back. Because your expenses are more on this side of the ledger, it means you'd get a bit more tax back over here. So this person, as I worked out on 100,000, instead of 4,414, as you can see in the first example up here, they would be getting back around about 7,672. Okay, so they'd be getting a bit more back. So what would they be getting in here? Okay, I'll just have to write the number in there. So the amount they'd be getting in here would be, after you take all these numbers into account, the difference would be 1,318. So 1,313 would be the amount now that they would be getting instead of 7,504. But this is still positive cash flow over the course of a year, okay, after all your expenses. Again, just remember that this rent comes down here and these expenses come down here. All right, I'm just not going to type them in. But so with a higher interest rate, a 2% higher interest rate, you're still getting a cash flow positive property that is still allowing you to hold it over a period of time. Even if this is negative, which it is sometimes as interest rates go higher and higher, it's still a small amount. What you have to be looking at is not really thinking about how much money can I get cash flow here. This is really designed, these cash flows are designed for you to be able to hold the property through time, because it's the growth that you want. The growth is the thing that's going to set you free, not the cash flow. The cash flow just allows you to hang on to the property. Okay, so I hope that's explained it a little bit. It's maybe a little bit of a messy drawing here, but I hope you can see that the cash flows aren't affected all that much. Yes, it makes a difference, 6,000 less or so to get down to here, but the point of the matter is you're still able to hold on to the property. It still isn't costing you an arm and a leg. In fact, it's still paying you to hold it. And as I proved before, interest rates don't have that much effect on the growth in terms of, when you look historically, they've survived all manner of things. So don't get too caught up in that type of thing. The fact of the matter is, just remember, like I said before, you want to be holding these properties for a long period of time, for quite a few years. You don't want to be like shelling in and out. You've got to be hanging on in there, so that time gives you the compounding, which is the main factor, the main benefit that you'll get from the property, which and that compounding growth will really, really change the game for you. So I hope you found that useful, and if you want to have a chat with me about your own situation, you can click below the video somewhere here, and I'll be in touch with you. Okay, so I hope you found that useful, but it's bye for now.